The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Well, hello, Buffalo. In Western New York, it is Ask the Tax Lady, but we decided to give her this Saturday off. So this is Chris Fabian from EG Tax. Hope you all are enjoying your Memorial Day weekend. Wish the weather could be better for everybody, but a little rain doesn't hurt anybody. But it's not a little rain. We're starting our summer series today. We're going to have Dennis Kitchen join us, a general lawyer that can answer your questions. Free legal advice. You can't beat that. Free tax advice. It's a win-win for everybody. I'm joined in studio today with my beautiful wife, Tiffany.
Hey, happy Saturday. Happy Memorial Day. And glad to be here.
Yeah.
Maybe you're going to touch on this, but we would be remiss if we didn't talk about the tax changes that have passed the House, and they're moving on to the Senate. And if the Senate passes it, then it's back to the House and then to the president's desk, right?
Yep. So hopefully July 4th, we'll get all the fine details. But the big, beautiful bill did pass the House, and there are a lot of different things in there for every taxpayer.
Yeah, I think an exciting thing is the interest on car loans if the car was purchased in the United States.
American made.
I'm sorry, not purchased, but American made. Thanks. And so what an exciting thing. And because cars are really expensive nowadays. I mean, really expensive. And it's quite an investment. And so it's nice to be able to take advantage of that. The SALT deduction, it was limited to $10,000, and I think they're widening it. Correct me if I'm wrong, Chris. $40,000.
Could be up to $40,000. Yep.
Which is really exciting, especially for us New York State folks who pay a lot in property taxes. And then for seniors, there's the big thing is no tax on tips or overtime. And so Esther was reading the law. It looks like it's going to be an adjustment to income. Is that what you think?
Right. So it's going to be still subject to Social Security and Medicare, which is a good thing because it will help people when they're older and get more money so they don't have to keep working as hard when they're 65 and older, But so there'll be adjustments to income to back away. So we got to see how that's all going to work. But that, even if it's $25,000 a tax-free income, if you're in the 10% bracket, that saves you $2,500.
Right. That's really significant. And there's rules. It has to be somebody who's traditionally in a type of industry that is tip driven or existence. It can't be all of a sudden you walk into your employer and you work at JP Waterhouse and you say, I want to be paid in tips. It has to be an industry that was already derivative of tips, and this was part of their usual stance. It can't be that you want to walk in and change.
Switch from salary to hourly, so then you get overtime.
Right. And so that makes a lot of sense. And then also, Esther rightfully said it was sort of disappointing for the seniors because she thinks they get taken to the woodshed, and where they were talking about no tax on Social Security. And so that looks like that was pushed off to where seniors will get a higher addition to their standard deduction. And so it's something, but it wasn't really what we were hoping for seniors,
Right. So, but it did pass leg one. Got to go to the Senate next. So keep tuned.
If anybody has questions about it today, we'll do our best to answer it. So give us a call at 803-0930 or star 930 on a cell phone, or you can text 803-0930.
Right. Good job.
I know my back is to the text board, so I don't see. I'm doing it all shooting from the hip here, right?
Yep.
And Dennis, are you excited about some of the tax changes?
Well, yeah, that should be interesting. I think everyone can take advantage of something there. Yes.
Right. I mean, I mean, Trump really, there's talk about he wants to make taxes easier, and so I think planning is going to be really important because there's going to be seniors who, because of these changes, can take more out of their IRAs, and so I think we really, once this is passed, we really have to make some deep conversations with people, right, Chris?
That's right. A lot of tax planning is going to go into effect. What to do for seniors? Can they roll more money into a Roth, take more money out tax-free, before the RMD or even after the RMD, they might be able to take more out. For younger people, it might open the door for single parents to getting earned income credit and additional child tax credits more. So
Yeah, you're right about that because of the tax and tips, right?
Yep.
And the tips and the overtime. That's a really good point. And then I think more people are going to be itemizing. There were a lot of folks, especially our married folks, who were not itemizing on the federal. And now they'll probably be able to itemize, which is really good. And then we don't know what New York State is going to do with any of these changes.
Exactly. I don't think New York's going to know what they're going to do yet.
No,
either.
they'll wait a few years.
Exactly. But really good questions. And it's all really important. And then I was going to ask Dennis about estates. And then Esther was saying, Chris, do you know some of the nuances of this? Is that they're talking about getting rid of the limit on taxation of your estates. You've heard about that, right, Chris?
I've heard very little on that. So Dennis probably can answer a little bit more better than me.
Yeah, so there's there's the estate tax, and so they're thinking about removing
Right. So
it.
Dennis, what?
Well, that's always been a subject of discussion, and for the average person, of course, the discussion is academic, because the limits on estate and gift taxes is what is it, 16 million right now?
Something like that for the federal. Yep.
Yeah. And for New York State, it's something like about 7 million.
Right.
Yeah. So, I mean, my clients come in, they say, well, I'm concerned about the estate tax. And then I tell them the limits. And they breathe a sigh of relief.
Right. Are you worth at least $7 million? No, I wish.
Yeah, or 18 million or something like that. Yeah, but I think they're thinking of increasing that federal threshold or New York State, which is really exciting. And so estate planning, turning to Dennis, who needs to plan? I listen to your commercials, Dennis, and your commercial says if you don't plan your estate, New York State will do it for you, right?
Right.
And so what does that mean?
Some people fear, gee, if I don't have a will, it means the state will get it. No. The estate, the New York State and all other states have written a will for people who don't have a will. It's called the laws of intestacy, meaning you don't have an estate. So what they say is, okay, if you have a wife, it goes to your wife. If you have a wife and children, it goes partly to your wife and partly to your children. And that's a limitation that a lot of people wouldn't like. The typical family would say, gee, I want to turn everything over to my wife. My kids are small or young or whatever, and or maybe they're older, but they're irresponsible. So I just assume it all went to my wife, and that's usually the typical will that I do for the average person. So.
Yeah. Whereas if you don't do it, New York State has something in plan for you.
That's right. They'll divvy it up between the two.
Yeah. And so usually you want to make your own choices and your own decisions.
But now, of course, we see a lot of alternatives to what the will does. The idea of adding names to a bank account as a pay on death. In other words, they don't have access to the bank account, but once you pass away, the bank account becomes theirs. That can be applied to a number of other financial vehicles. So
Yep. That's when we're talking about TOD, right?
Yep, right.
I think
And we'll talk more about this after the break. We'll talk to John, who's been waiting. So we'll catch you on the other side. And we're back, guys, on this wonderful Saturday, talking taxes, talking legal summer series here with EG Tax. But we're going to go to the phone with John. Hey, John, how can we help you?
Yeah, hey, thanks for taking my call. Can you hear me okay?
Yep.
Yeah. Well, I'm retiring here at the end of June.
Congratulations.
And thank you. And I am going to take I'll be, I don't know, by the time I actually get Social Security, I've applied, I'll be about 63. I'm taking it early, a little bit early. Anyways, long story short, how does it work with, like I will have worked half the year and made, a certain amount of money, but I keep hearing stories about if you exceed a certain amount, like about $2,000 a month, that you can lose they'll take back your Social Security, like 2 for 1 for every dollar you earn over that. How does that work if you've already worked half a year, or doesn't it matter?
I know they do. They do have certain limits for the year you do retire. It's right now. If I'm trying to Google it.
Yeah, he's doing that right now. I know. So when you are completely not working for the year, the limit is about $18,000. You'd have to pay back $1 for every $2 you're over. And then I went into Chris's office a couple months ago, and I asked him this very question, and Chris proceeded to tell me to have the client call Social Security because there are special rules and limitations the first year that you retire. And so Chris is feverishly trying to look up the answer right now, and I don't know how you're doing, Chris.
Yeah.
Did you ask Social Security, John?
Well, when I first filed, I talked to him about it, and then I've been having a hard time. There's only so long I can wait on the phone to call them up, but I did get a hold of them. I thought they said on a monthly basis it was about maybe $1,900 a month or something like that. But I don't know if I ever asked them the question: does it matter, like if you earned wages the first half of the year, or is it all just monthly? I wouldn't think they would penalize you for working half a year, right? And then if you went over the maximum for the year and you were working. I don't know, but I guess that's my question.
Yeah, one of the things I'm finding is if you retire in October and earn $45,000 that year, but your earnings in November and December are $1,950 or less, you'll still receive your Social Security benefits for those months. So
that sounds about right then. So it's how much you earn maybe after you retire per month.
Yeah, but I would definitely like to have said how we tell people call Social Security, get it from the horse.
Yeah, I know when you call Social Security, there's an option for them to call you back, and they really do call you back, which is really good.
Okay.
But it's a really common question. And then after you retire, you're going to keep working, or you're going to stop working?
I'm not going to work much, very little.
Yep, and so that limit then will come into play. Which is really, and then when you another problem when people retire is they always worry about their health insurance, and so you already have that all established and set up, right?
Yeah, I'm good with that until I get Medicare age, and then 65. I have to switch over. But I'm good for
that's good.
Until it is definitely good.
Yeah, and then if you struggle finding the answer, you can call the office 632-7886. We'll try to find a more detailed. Or if you want to call us and tell us next Saturday what you find out, we would appreciate it.
Yeah, I'm getting close. So I'm just wondering, but it sounds like what you said is after the fact. But I think I'll call them and have them call me back.
Sure.
That's a good idea.
Yep.
Because you don't want to pay back any of the Social Security.
No. The only other thing I did hear a little bit is like even if you do have to pay back, that once you reach maximum retirement age, for me, which is like 67, you do end up getting that money back. I don't think all at once, but I think they pay it back to you over time.
Right. Yeah, Esther said that last week too.
Yeah.
So there's a catch, which is good. Well, enjoy your retirement.
Well, thanks.
Thank you.
Yes.
Yep. Take
Congratulations.
care.
Hopefully it'll be sunny for you.
I hope so.
Thank
All
you.
right.
Okay. So that's a good question there. Good question.
Yeah, really important. And Esther would be proud of him because he's collecting his Social Security, right?
Yeah, and not waiting.
Right, right. And then hopefully the new laws will take effect for John and less of his Social Security will be taxable.
Yep.
I mean, what age are they putting on that extra standard deduction? Do we know?
It just says if you're a senior. So I don't know if it's going to be anybody who collects Social Security or if
Right.
it's going to be 65.
Right.
So-
Right.
It's going to be a wait and see game. But before the break, Dennis, you were talking about wills and all that and how the New York State has, just in case if you don't, they already have one written for you. But how often should people update their will?
Well, you should look at it probably once a year. That time, maybe the end of December, around New Year's, when you start thinking of New Year's resolutions, will be a good time to kind of just pull the thing out, take a look at it, make sure what it says and whether it does what you want. Usually we try and draw wills that provide for contingencies, like if one of your brother dies or something, we know we have an alternate in there. If your mother passes away, well, this is what will happen. Sometimes we try and avoid it so this person doesn't have to change it frequently, but it should be reviewed frequently.
Yeah. And how about, I know I see this a lot and a lot of people hate it, the executor. Who should you put as your executor, or should you have more than one?
Well, frankly, sometimes people have a will solely to select who is going to be the executor. And by the way, that's often one of the most difficult questions. If kids have moved away, but one's here, should you pick the one that is here? Is that the one that's most responsible? Is that the one who's taking care of you? Well, that depends. And are you one who likes to treat your children equally, so you're going to make them all executor? Well, lots of luck. If they work together, well, fine. If they don't, well, not so good. So I usually have some discussion and maybe help them reach a decision on that.
And then, Dennis, what do you think about, we hear all the commercials for those online do-it-yourself will and lawyer services. What do you think about all those?
Well, they probably do a reasonably good job. It supposedly is reviewed by an attorney and they'll follow certain guidelines and that sort of thing. However, your local attorney, myself, or plenty of other my colleagues out there, they don't charge extensive amounts for a will,
Right.
And it's usually just a few $100s, and often what they add is things like a life estate, a living will, a living will, a healthcare proxy, and a power of attorney.
Yeah.
And they can also discuss other ideas about perhaps transferring a home and reserving a life estate and giving some other ideas.
What makes a will legal?
Well, what makes a will legal is if the signing of it is witnessed by two witnesses in New York. That varies from state to state. Some require 3 witnesses, some require 2 witnesses and a notary or something like that. But you don't just take a will down and have it notarized at your bank. They won't touch it. If they see will at the top, they're going to just be shaking their heads. They're not interested in any of that sort of thing. But wills are not notarized. They are witnessed. And that's how it's done.
So somebody, and I could see this happening nowadays, goes to what is that? The
GPT.
Chat GPT.
Yeah.
Write me a will.
Write me a will.
Yeah.
And
Oh, yeah. And
will those suffice?
Well, they may. I mean, first of all, they're going to look at it. Has it been signed? Has it been witnessed? Was the person competent at the time? And assuming that those questions are answered affirmatively, then they might look at the content. Now, then sometimes wills don't make sense. Sometimes they have contrary provisions. Sometimes they say things that the heirs will say, "Oh, he certainly didn't mean that," and somebody has to figure that out. So,
Okay, we're gonna go to Gene in Lancaster. He has a question for you, Dennis. Hey, Gene, what's going on?
Yes, hello. How are you today?
Good.
Got a question about estates. How long can you keep an estate open?
well, you'd be surprised how long they do sometimes remain open if there are complications. When the person gets files an estate with the surrogates court, and the executor or administrator gets appointed to handle the estate, it has to be open for 7 months because it has to allow time for creditors to come forward and present claims. And that's true even if you think, well, there's no creditors. Well, you still have to be open for 7 months before you can close it. But as far as the outer limit of it, well, sometimes notifying other relatives and taking care of the property, which can be sometimes, maybe there's multiple real estate property. Maybe there are things in other states that require a proceeding in that other state. That can leave an estate open for several years.
Yeah,
Years.
What were you going to say? I'm sorry. What were you going to say, sir?
So several years. That's and if it's income producing estate, do you have to file taxes?
Yes, income taxes on estates. Instead of a 1040, it's a 1041. And you have to, if there's income on it. It's typical when you have, let's say, a rental property or something like that, and also when you have maybe stock that produces dividends. And
Yeah,
that sort of thing.
Gene, we're going to put you on hold because we got to do a hard break for the news. This is EG Tax, and we'll be right back. And that's right. You are our family out there. Anybody in this listening area, you are our family. And that's why we do our summer series, because we want to keep you informed and get you the best advice you can have. And, and I don't know, Tiff, was that a live commercial or was that a recording? Yes, we have Dennis Kitchen in studio with us today, talking law. We got tax questions, anything like that. Give us a call here, 716-803-0930, star 930 on your cell phone. You can text it in at 716-803-0930 as well. And we're going to go back to Gene. Go ahead, Gene.
Yes. Dennis mentioned about rental property or real estate, and also maybe stocks, dividends, and in the deceased's name, that's revenue producing. Would it be advantageous to keep the estate open because most likely they're in probably a lower tax bracket?
No.
The
You
estate?
know what's so funny? When somebody has an estate, our wish, our hope is that they get the proceeds distributed as soon as they can, because you're going to turn it over to somebody who pays at an individual rate, which is much, much lower than the estate rate. So our wish and our hope is that the things in the estate are handled as quick as possible.
Yeah, because the estate rate pays the maximum tax of 37% at $12,000.
So you have it opposite, Gene.
12,000. Pardon me?
Anything over $12,000 gets taxed at 37%
Gulp.
on the estate.
That's a lot of money.
For an individual to get taxed at 37%, a single person would have to have over $450,000.
Oh, I see. All right. And that estate is for the first year. It would be. That's true for the first year. 37%.
Well, it depends on the income. All depends on the income, and if anything was distributed. So.
And then I was thinking, if they have a rental in there, the sale of the rental, right, Chris?
Yeah. But the nice thing is the estate gets the stepped up basis.
Yeah. Yeah.
So
But the rental income, so the sooner it's settled, that's
usually the better.
And Dennis, you agree? You were nodding your head.
Yes, because the first year usually doesn't take a big hit because you usually have a lot of expenses getting the thing rolling and everything that can reduce the income there. But when you move into the second year and things just kind of languish for a while, you can have income rolling in and incur some high tax.
Good question.
Very good.
Very good question, Gene.
Thank you very much.
Okay.
Thank you,
thanks.
Gene. Oh,
By the way, I should add that when an estate is open and everything, their distributions can be made to some extent, partial distributions, which
Are a good idea.
yeah, it can be helpful, of course. And if you get the high income stuff out of the estate, you've solved the income problem.
yeah, we're gonna read a text
And
and
then
then
I
go
want
to
to,
Mike.
before you read the text, I just want to say that it's so smart of Gene or whoever's out there to ask the right questions, and because then knowledge, you can run with that knowledge. Okay.
Knowledge is power. So we got an awful long text, but basically it's, we'll abbreviate, we'll do the Cliff Notes version. He's the executor of his mother's will, and there's 3 siblings, and he's wondering, can he take a fee?
A larger fee because he's doing more of the work.
Well, this is a talk I usually have with executors, particularly when, say, a house is involved and it's one of these things where you got to get a dumpster in the driveway to be able to take care of everything. And they're working, I say, look, you do not get paid for this because you are entitled to a commission. And the commission is 5% on the first 100,000, 4% on the next 200,000, and it goes down from there. But that's what your compensation is supposed to be. So hire people to help you. If the money is difficult, get an accountant to help you. If you have stuff where you just need labor and things like that, you could hire your relatives, hire your friends or whatever. But people who can do something for you, those you can pay out of the estate. You can't pay yourself other than the commission.
Also, if you do take a commission, somebody might not think of this, that commission is taxable.
Yes.
So you got to pay tax on that commission. Where if you take out $10,000 as your fees, you're going to pay tax on that $10,000 on your personal level. Where if that's just sitting in the bank account and you inherit cash, that's tax-free. Yeah. So you just cost yourself some money.
Well, some people, sometimes I get people who are not only the executors, they're like the sole beneficiary. And they say, well, do I get anything for being the executor? I say, well, yeah, but you don't want to take it as commissions for an executor. You just want to receive it as your inheritance, which is tax-free.
Dennis, for the listeners out there, again, could you do those commission rates again for being the executor?
For executor gets 5% of the first 100,000, and then 4% of the next 200,000. Then it drops to 3%. Then it goes to 2.5%. But
Okay.
but that's getting up into the high levels.
Okay.
Yeah.
So
Okay,
there you go.
Yep. So let's go back to the phones, and we're going to talk to Mike. Hey, Mike.
Hello. A question about irreversible trust. Say there's 2 children named in it, and one child gets in an auto accident and gets sued and loses. Can the house that the parents are living in be taken away before they die? I know it's odd, but this is possible to happen.
Well, of course, the details of the trust may have some effect on this thing, but the typical irrevocable trust is not going to be subject to it. The trust then owns the house, and the trust didn't cause any accident. And even though one of the beneficiaries of the trust is in trouble, and it may mean that if they're supposed to get a share in 3 years of $20,000 or something like that, that may end up going to them. Both the trustee and the and the recipient of this, who's facing a big lawsuit or something, needs to consult with an attorney about that fact.
Because that would be the same like a life estate thing, where the house is or they have a right to live there until they die.
Life estate is a little different. Now, life estate, of course, is a situation, and I have a lot of people who do this. They have a house; it's their forever house. They're going to be living in until they die, sort of thing. And so, to help the transfer of it and make it a little smoother and easier, they go ahead and transfer the house to their children. And reserve a life estate, meaning they're paying the mortgage, they're paying the taxes, they're paying everything else while they're living. But the moment they die, the house will belong to the people who are called remaindermen.
So what if the remaindermen get in a car accident while you have a life estate?
I was going to ask that.
You have a problem.
You have a problem?
Yes.
So that's one of the cons. I mean, it may be remote, but never say never.
Yes, it is. That's why I always ask, are any of your kids, maybe going through a divorce or facing some sort of financial trouble or something like this, because they've got an asset. You could, if you go bankrupt and you happen to be the remainderman on your mother's house, that is an interest in that house that can be sold. There are people who will buy those. Wait for your mother to pass away, and then they will own the house. So that's something to be considered.
Okay. Do I have a question to ask about the new tax bill?
Yeah, sure. Absolutely.
Okay. Now, the $4,000 deduction, I guess it's, say
for Social Security.
Right. As far as that's what's proposed now. Of course, it didn't go. But if it goes through, what happens, say adjusted gross income is say at $40,000 for a senior couple. Now, how much will that $4,000 actually be off your tax bill then, or less taxes you pay, I should say?
Well, it all depends on your income, and is it going to be? We see these are the fine details that aren't out yet. Is it going to be $4,000 per tax return or $4,000 per person? Because for a married couple, that could be potentially up to $8,000,
which would be significant.
Which would be
for both. No.
Yeah. See, that's the thing. All these fine details aren't
ironed out.
Aren't ironed out yet and aren't disclosed. So
but it's not $4,000 less in taxes you're going to pay.
No, it's not $4,000. It would be like an additional $4,000 on your standard deduction.
So, say if you had $40,000 income or adjusted gross income, would that be a couple $100 then off your taxes?
Well, yeah. If your AGI is $40,000 and you're married and you're over 65, your standard deduction is like $32,000. Then with these other, if it is $4,000 per person, that would bring you up to $40,000. So you may pay no taxes. So that would save you possibly $800 to $1,000.
So, but they may tinker with that in the Senate.
In the Senate.
Yeah.
Yep.
Okay. Thank you.
Good questions, Mike.
Of course, after the bill passes, even if it passes both houses and gets signed by the president, then it gets dumped onto the IRS, who must come up with the forms and the books and the regulations and the rules.
Yep.
Yeah.
Yeah.
Not easy.
No. Tax changes are always fun.
Yeah.
And then it's only set in stone for a few years, and so then and go back to the drawing board again, right?
Exactly.
Yeah.
Exactly. We got another text. It says, if you're under 59 and a half, can you take out of a Roth without any penalties? My son wants to buy a house and he knows he can take $10,000 out, but he's hoping he can take out more. Thank you. So, first of all, he has to be over 59 and a half to take it out without penalties. Mm-hmm. He can always take out his principal from the Roth, but not the growth, tax-free. So if he put in $40,000 of his own money over his life, and now it's worth $70,000, he can take out the $40,000 that he put in and pay no tax, no penalties. So it can get a little bit tricky. I would suggest giving our office a call on Tuesday. We are closed on Monday this week for Memorial Day, but give our office a call on Tuesday, 632-7886, and we'd love to run some numbers with you, so we hopefully can get your son this house.
Yeah, great idea. But yeah, it's the growth that's taxable if you're under the age of 59 and a half. So really good question. And then Mike asks a really good question. It's almost like you need a crystal ball before you do certain things, which is impossible to have. And so with the life estate, knowing what's going on and that people could still get their claws into things, right?
Yes.
Yes.
Yep.
Really
So
important.
let's take our final break of the show. We'll be back in 2 minutes. And we're back, guys. Family. I can't talk.
Hey, I'm here to bail you out of that. So, Dennis, gifting. People call us all the time, and they say, look at in that example, my son wants to buy a house. Can I gift him money and maybe his spouse to help him with that house purchase? What is the limits on gifting?
Well, the limits on gifting, first of all, the limits on gifting are tied in with the estate limits. So ultimately, you're only really going to be paying tax on a gift if it exceeds that 16 million federal and
Do you know
7
anybody
million.
that can gift me that kind of money?
No. And my clients don't either. But here's the thing. If you'd like to avoid having to file a gift tax return, it won't involve paying the money, but it'd be the annoyance of filing a gift tax return. The gift should be under $19,000.
Yeah.
But that's $19,000 per person. So you and your wife can file. Can give $19,000 in 1 year.
Well, they could
to
give
your kids.
38,000 to their son,
$38,000,
and then another 38,000 to their daughter-in-law.
Exactly. So you end up with what is that?
$76,000.
Yes, right.
And do the mom and dad get any benefit for gifting? It lowers their estate, but do they get to write off something? Everybody calls us and says, "Is it a tax write-off for me?" Or
No,
No.
it's no tax to the recipient, but
Yeah.
no tax savings to
Right.
the donor.
right?
That sort of thing. Maybe the kids will show up for Thanksgiving dinner.
Exactly. There you
Maybe
go.
they'll get more if they show up for Thanksgiving and Christmas.
Yeah, absolutely.
But Dennis, how can people get a hold of you during the week?
Yes, they can give me a call at my office at 631-5661 in the 716 area code. There, my office is out in Clarence, actually, about a mile and a half east of Transit Road.
Yep. It's great advice. Always willing to talk over the phone. I know, I think Chris called you the other day about a client considering bankruptcy.
Yes.
So you also do bankruptcy law,
Yes.
which is really important. Nowadays, I think it's written into the new tax code. I think Esther talked about this, I know I'm sort of getting off the topic, but I'm going to bring it back to bankruptcy. But Medicaid recipients, if they're able-bodied, they have to maybe go and work a little bit, a couple, like 3 days a week or something like that. But where I was going with this is student loan interest. This is another thing, is that he's shutting the door on it being forgiven, many of those programs. And so is student loan debt something that somebody can wrap into a bankruptcy?
Student loan industry is an impenetrable morass.
Well said.
There are something like, I just attended a seminar, there was something like 70 different programs for dealing with your student loan and making it easier or better or something like that. They're really, I think the people who are really hurt, of course, are the parents who have signed on as co-signers on some of these loans,
Right.
or taken the loans themselves. And how do they deal with that student loan? That is not easy. It is not usually released in a bankruptcy unless you have a hardship. Now, there's some hardships that are very easy. If you happen to be on Social Security disability, they are going to forgive your loan. But if you are not, then then you have to resort to other things, the hardship. It might have something to do with the nature of the education you got or didn't get. Did you complete? Did you get your degree? Are you working in your field? You know, if the answers to some of those questions are no, well, there may be some give on that if you happen to go through a bankruptcy. But there are people you can consult for that about student loans, and there are procedures for dealing with that question.
And are there still, I know they changed the law a while ago, before you file a bankruptcy, do you still have to take classes?
Yes.
New York State.
That started in 2005, and they require you get a credit counseling, which you can do online. It isn't even very costly. It's about $10 or $15. And you do, after you file, you have to take another one. That is the personal financial management course, and that takes about an hour. You can do it online. You can attend these things live, but I haven't known anybody who did it. So it's a rather minor thing compared to the bankruptcy itself.
And are you seeing more bankruptcies because of the higher cost of items now with inflation?
Yeah, right. The fallback for Americans when they lose a job is their credit card, with the idea that if they get employed quickly, they'll
pay it off,
themselves out of the hole. But you know how the holes that are created by bankruptcy or by credit card companies and banks are very difficult with their interest rates of 25 or 30% or something like that. So it's really tough to get out of them, and if you pay them the minimum payment, you're going to be paying for a long time. So bankruptcy is something that should be at least considered. I meet with debtors who have debts like this and just talk about it and decide whether bankruptcy would be helpful for them. If it isn't, I say so, and that's it. If it is, then maybe I can help them.
Yeah, and then say it's a married couple. Do both parties have to file bankruptcy, or can just one or the other?
Just one of them can.
Okay.
Yeah, so
Okay.
that may be helpful. If you only have one who's got the deep debt and that sort of thing, then leave the other one out of it.
Right, which is a good idea. And then since we talk about the IRS in New York State, can IRS tax debt be wrapped into your bankruptcy? I think it's paid back dollar for dollar, right?
Well, actually, you can go bankrupt on an IRS debt, but it has to be, of course, just for income tax, and it has to be at least 3 years, and it has to be before the IRS has filed a lien. So there's a bunch of little hoops to jump through to decide whether that's
feasible.
Yeah. Possible.
Interesting. Okay, well, let's go back to the phones. We got Chuck from Amherst. Hey, Chuck, what's going on?
Hey, how you doing? Hey, just a curiosity here. I caught some of this where you said 19,000, under 19,000 can be gifted to each individual child. Is that correct?
Yes.
Yes.
Okay, and then I heard something about 38,000. Where did that come in?
Well, if your husband and wife, give a total of 38,000.
And mom and dad.
Yeah.
So Chris and I are married, and so we could give our daughter each 19,000, and then if she's married, I can give her 19,000, her spouse 19,000. Chris can give daughter and son-in-law 19,000. So it's a lot of money.
And if they're listening, no, you're not getting it.
Hey, okay, and one other thing. What was the phone number to reach your office? Because we have some things going on with my mother, and we'd like to figure out what to do with her large investments that she has, and she's already at the point where she's going to have to possibly go into a nursing home, maybe. Yeah. And we want to be able to protect those assets because my father indicated before he died that he did not want one penny spent on a nursing home, and that the grandchildren and the children were to receive something after, of course, he passed away, and then, of course, after my mom passes. And we're trying to make sure that he worked very hard for that. He wanted to make sure everybody had something because he was a good father, and we want to make sure that his wishes are handled properly.
Well, Medicaid planning is a process in itself. Sometimes it can be done fairly simply, and sometimes not, because any kind of transfer that person makes from their own assets will be possibly make them ineligible for Medicaid for a period of time. So that's why people do a transfer of their house and reserve a life estate.
But and what is your phone number, Dennis? In case he's got a pen in
yes,
hand.
That's right. 716 Yep, 631 5661.
5661.
Yeah, but very smart to plan. Very, very smart, because you're right. We all have relatives that we know that have worked their whole life, and then all the money goes to nursing homes, and it just breaks your heart. And so you want to, be as wise as you can. I think Esther's always really good at being wise, and I think Dennis and Nancy are also very wise at being good.
Does this also include? Sorry for interrupting. Does if you have Charles Schwab investment stocks, things like that, does Medicaid look at all that stuff too?
Well, yeah, unless they're in a qualified, investment. That's sort
a
of
trust.
Yeah, a trust like that.
So a trust.
And as long as the trust has been in effect for at least 5 years, then it won't affect it.
So you really got to sit down with Dennis and do the work now, not any later.
Yeah.
Yeah, definitely.
There are some techniques for dealing with kind of last minute stuff, but
Right.
I'll talk about it with you.
Okay, great. Look forward to talking with you. I'll give you a buzz sometime at the end of next week after this holiday weekend, and then appreciate it. Thank you.
Thank you.
Thanks.
Thank you, sir.
Happy holiday.
And so Chris Fabian, Tiffany Fabian here from EG Tax with Ask the Tax Lady.
And I hope it's okay to say, if anybody, I was at the drive-in last night, and a client texted me about a letter that they got, and they tried to call New York State themselves. I implore you, don't call New York State yourself. Let us help you with the letter. Please, it's what we look at all day long, and there's so many rights and lefts and loopholes. So give us a buzz at 632-7886. And then, Chris, I'm sorry for stepping on you.
Oh, you're fine. Yeah, don't fight the battles alone. That's why we're here for you. But next week we're going to dive more into the big, beautiful bill, hopefully answer some more of your questions. If you do have them during the week, give us a call at 632-7886. Go to our website, egtax.com, click Ask the Tax Lady, and that goes right to Esther, and she does answer them right away, no matter what time of day it is. So we're always there for you. If you're looking for something to do tomorrow morning, go cheer on the runners doing the Buffalo Marathon. There's nothing more exciting than cheering those people on, because they need it.
And go Bandits.
And definitely go Bandits tonight, half an hour, face-off time to win that championship 3 years in a row.
Repeat.
So until next week, Chris Fabian, we'll see you then.